Today, we are going to talk about the different mortgage rate types. Choosing the right mortgage type can be confusing. With so many different options in the market, it's important to understand the right one for you and the right one for your circumstances. From fixed rates to variable rates to standard variable rates, discounted variable rates, it's easy to understand why it's confusing. So, I'm going to go through some of the key options to give you a little bit of insight into what they are. And the first one that I'm going to talk to you about is the fixed rate. In recent times, the fixed rate has proved to be the most popular type of repayment. And the reason for it is it gives you a set payment for a set period of time. It is a stable monthly payment. This provides protection from market conditions. So if interest rates are going up the way, you're protecting yourself from any of these potential changes. What you are losing out on, though, is the option to be flexible if interest rates come down. So if interest rates do come down the way, your payments won't and they will remain stable. The fixed rate mortgage is ideal for people who are looking for that stability, who want to know exactly what they're going to be paying each month and to be protected from market conditions. What people with fixed rates can often do as well is you've often got the ability to make overpayments, typically a percentage of the loan amount that you've taken out. So what some people will tend to do is set a lower fixed rate and then make overpayments, which is perfectly fine as well. But you need to be careful when doing that, just in case you don't make the overpayments and the mortgage lasts for longer than anticipated. The Although the fixed rate does have some key benefits to it, there are some disadvantages, as I touched on. Because you're tied into it and you've committed to it, to come out of this deal early, you could have early repayment charges. So the lender could charge you for doing so. So in a period where interest rates are consistently coming down the way, and if you've tied yourself in, if you're trying to come out of your fixed rate, you can do it, but you'd typically be charged to do so. That's where, if you're looking for that kind of flexibility where your interest rates will track the market conditions, you've got what's called the tracker rate. Now, a tracker rate is a form of variable rate. This is linked to the Bank of England base rate, and the interest rate is set at constant levels above or below the base rate, although interest rates below the base rate, haven't seen any of them in quite a while. But typically speaking, your interest rate will be set at a certain percentage above the base rate for a period of time. This means that whatever happens with the Bank of England, if they're putting the rates up, your interest rates will follow. If the rates come down, they will also come down the way. So you do get the advantage that your mortgage will move in line with those kind of market conditions. And if rates are dropping, you'll be able to get the benefit of it. Key disadvantage is because it is variable. If the base rate goes up the way, you could end up paying more. And if you decide at that time that you're wanting to fix and avoid paying more, what you would usually find is you would be going on to a higher fixed rate because the interest rates in the market are higher as well. Doesn't always work out like that, but typically speaking, the market tends to follow what the Bank of England is doing. The other type of mortgage that you've got is the standard variable rate. Now, the standard variable rate is a monthly payment determined by the mortgage lender. So, as I mentioned just a moment ago about the tracker rate, typically speaking, the rates in the market and the rates dictated by lenders will follow the Bank of England base rate. However, it's not always guaranteed. So, what could happen is the Bank of England base rate could come down and then the lender doesn't pass that reduction on to you. So that is a key disadvantage of it. But the advantage on the flip side of that is that the lender could increase their interest rates. Sorry, the Bank of England could increase their interest rates, but the lender doesn't. The lender's already set their rates at a level that they're comfortable with because of where they're getting the money from. And yeah, there's no change in it, and they don't change that for you. So that's one of the key advantages is that there may not be changes if the market changes. So take into consideration if you're going on to a standard variable rate, it also gives you a little bit more flexibility. Usually, if you're on the standard rate, there isn't many or there isn't any early repayment charges. So sometimes when I'm talking to clients, sometimes what I'll do is if we're waiting on something happening or if we need a period of stability, we can leave it on the standard variable rate for a short period of time before committing to move it somewhere else. In line with the standard variable rate, you've also got the discounted variable rate. So this is very similar to a tracker rate where instead of just giving you the rate that's a standard rate, you're getting a discount on the lender's standard variable rate, and the discount follows it as at a set percentage for a period of time below that variable rate. It's offered by some lenders on their standard rate. Not every lender out there offers it. It's in recent times it's proved to be quite popular as well because of the increase in the market. Some lenders discounted variable rates were a lot lower than the fixed rate options available, which saw a huge influx in people taking up these options. It is lower than the standard variable rates. However, what you typically find with the discounted variable rate is that you're tied into it for a period of time. So you can be tied into it for, say, a period of 2 years, which means that if you find that throughout a period, the interest rates and the payments continually go up the way, if you're trying to come out of that, you will be subject to early repayment charges, similar to what you would have if it was a fixed rate. Now, in summary, a fixed rate option does remain the most popular option, especially for first time buyers, but it gives people that period of stability, get used to the costs of owning a property, and the guarantee that the payments aren't going to change while they decide on the long term of what they want to do in that property. But I hope you found this useful. If you do have any other questions, feel free to fire them over, and please do like, share, and subscribe. Cheers.